All right, give him a warm welcome.
Good morning, everybody. Can you hear me? Yeah, no. Good morning, everybody. It's a true pleasure to speak to this distinguished group of community here. And I'm very, very happy to give you some more insights from the venture perspective, what the value inflection points may be, and how we successfully balance those expectations with the reality. Longevity is the right place to be. We are on the right side of evolution. It's a nice future at the right time. It's a 1 trillion opportunity, and you will know all of these. The market for major age-related diseases and longevity interventions is huge. So digging into this, well, we have heard it yesterday already. So longevity is no indication. So there is no FDA-approved endpoint. And even if there was one, is it a surrogate marker? Is it an outcome, longevity, overall survival outcome, which will take us many years to prove? Now, but even if FDA would give us an endpoint, what about the reimbursement? Is community health plans, insurance companies willing to pay for such an outcome? So before all of this is settled, I think we should prove more the near low-hanging fruit endpoints, which are approved endpoints today. And longevity is a phenomenal opportunity to find substantial targets which have a real impact on all these approved indications. And the hope is that once you have a real longevity target, you will not just hit one of these, maybe 2 or 3 at the same time. So you can make a much more powerful impact with new targets to treat those approved indications or diseases and endpoints. That's the hope. So there, I think, is the near-term money where we can make impact and still develop the longevity aspect alongside an approved product. So what is the ecosystem we are living in now from the pharma perspective? And that's pretty important for us, because these are the big guys which are going to buy us. And as you can see, we have a strong increase in the loss of exclusivity, so patent life. And if you sum up the last 5 years here, 24, 28, we're talking 250 billion. So, boy, this is a lot to be replenished. And those erosions will be largely replenished to strategic alliances and M&A. So it's very good news for us. Now, we had a first cliff. You have to know that pharma has an approximate 7 years of exploiting a patent after the 13 years of development of a 20-year patent life. Okay, so now we have only 7 years on the market, and here come some new US government discounts to be negotiated. And they usually hit in year 3, 4, 5 of these drugs. And so we don't come to the full exploitation. In year 5, we get an additional cut, and which is dramatic. So what has been negotiated with the first 10 drugs here, starting 26, but today is already negotiated, is a 50 to 80% price cut most often, in most cases. So this means that for our biotech exits or longevity exits, the NPV will be discounted further. So a $10 billion drug may be discounted by another couple of billions as a value to the pharma company, because they can't exploit the full 7 years anymore. There will be less. So we have an additional cliff over the patent cliff, which is already so hard to replenish. That's where we are. Nevertheless, pharmaceutical industry had an unprecedented increase in the last years. I mean, we are now from up to 1.6 trillion. Okay, just 22 to 23 was 100 billion more revenue. Okay, so we have to put these cuts into perspective, what we are losing, what we are gaining, and I think we had a good ride. And if we get cut something, it's bad news, but it's still, in the overall perspective, it's still looking very good for us, I would say. I mean, we can, it's not nice, but we can survive this. Now, this is obviously a cyclic market. We are down to post-financial crisis levels in terms of IPOs. The average, the dotted line, you can see over the last 10 years was about 68 IPOs every year, and now we are down to 5. So this reminds me of 2008, post-financial. It's cyclic, it will come back. Nobody knows exactly when, but it will come back. So looking over the years, be assured this is going to come back. Now, the other part of the ecosystem is now the M&A. And here you see the M&A is pretty sustainable. As I mentioned before, pharma has to replenish all these erosions. And when you see here, we are almost at all-time highs in 23 in terms of US and European mergers and acquisitions. But we have to look at the blue and orange bars, not at the green and blue, which are the big ones. That's why I put in that dotted red line in here that you can see where we are living from, the VC style, pharma, biotech, biotech, pharma deals and biotech deals. These are much lower. We have 40 billion approximately over the last 5 years. It's pretty constant, and if you account for 40 deals around every year, then you have $1 billion per such a deal. It's only 40 companies. Imagine how many companies we have, So it's clear that there is a trend to if you can see here, the 15 biggest M&As were 80% of the total deal volume. I round it, and it's a trend towards mega deals. And 11 of the 15 deals targeted products in late-stage development and clinical trials or on the market. So now I laid over the red line, which was the IPO line, over the private merger acquisition. And boy, you see something interesting here. It's almost anti-cyclic. So when the IPOs are high, the M&As are low. And vice versa. So in 23, you can see that there's an 86% increase on the M&A investments, whereas the IPO is all down to all-time lows, And which means that we, as biotech companies, prefer an IPO over an M&A deal. Seems so whenever it's possible. On the other hand, pharma is going to wait us out when the prices are high, and they're probably not going to buy us. They wait for the next downturn, and then they come, as you can see, multiple times in the time frame 2012 to 2015, same behavior, 2020 to 24, same behavior. So I think this is interesting. I've never been aware of it. It was just a test, and I think this is an interesting outcome. So now, the other part of our ecosystem, which are the strategic alliances where we live from. And here, it's a little bit of a not so good story. So what we have seen, traditionally, we had about 12% of the total deal volume being upfront payments. And now we are down to almost historic lows with a 6%, 7% range. So if you look at this in terms of the real numbers, it's unbelievable. You have a $4 billion deal in biobucks and 50 million upfront. Yeah, and there are many, you go through the list, there are 3 where you have a $2.5 billion deal and 0 upfront, absolutely nothing. So I find this shocking because even as a venture capitalist, you give a certain amount of pre-money to a company. So a pharma company, I think there should be some value if they do a deal which they appreciate upfront. These things have to change. But from the venture perspective and from the biotech perspective, now it is that these bio deals usually take many, many years to realize. And so it's a questionable return of investment, and often only parts are realized. You have 8 drugs, $1 billion each or something, and then 2 don't make it, and then you may even have early termination prior to milestone achievement. We have seen this, and then again, the return is questionable. So the biobuck deals are right now not so pretty, but there's good. There's improvement, way to improve this, and I think we should negotiate better. So Having said that, regarding the raised capital, 2020, 24, and 5, I think are very good, will become very good years. And even 23 is already at a very high level if you look over the last 10 years. So venture investing is reduced, the green bar, but it's still high. And the debt is, of course, on the rise if you have less IPO and a little less venture money. Follow-ons are on the low. It's clear, and IPOs are basically not existent. You know, this is the ecosystem we are living in, but venture and the raising of the capital is pretty stable. This is very good news. Now focusing on this crowd where we are more early venture, here we have a trend which we already could see by pharma to more late-stage assets being appreciated. We have a second year now in the decline of amount and number of investments. So there is less money going into, and less companies are getting early stage money. So the move away from these early stage investments is a departure of the traditional avenues to fund early milestones, and we have to become a little bit more intelligent in how to approach getting capital for the early rounds. Now, here is the survival index, which is quite important. With collapsing IPO markets and reduced venture investing, it's clear that a cash crunch is approaching, and this reaching now about 31% of the companies 23. I didn't have new data for 24 for this year, but it's a very high number. So the importance of strategic alliances and biobucks are very high, but if they will only compensate a little bit for the cash needs of the company, and the potential exit value is capped. So if you discover a $10 billion drug and you have a $2 billion deal, you get once, you know. So it's better that you wait out until you have real value and you get a real exit, but sometimes you have to take these deals. There is, of course, high M&A activity, and when the survival index will be known to the buyers, they know they can get more reasonable prices, and those who can't get any deal or any exit, they have to restructure. So this is going on right now. You can read this in the news quite often. So some companies have to restructure if they can't get any deal or any further funding. The trend is clearly to clinical stage assets. So this is an overall venture perspective. It's not just biotech. It's just to show that you have here a 10-year high in the down rounds, which is normal after such a high we had in the 2022. So after that inflated valuation period, you must have down rounds if you want to raise money again. So I don't think this is so bad. And if you look on this one, the quarterly graphs are from the Carter, and on the other quote, the 32% level, which we reached, is the Cooley. It's just a Cooley report. It's just a quotation. They quote even 32% down rounds. So it's a ballpark, you know. It's not exact science. There's a lot of down rounds, but this is explainable because we had an overvaluation the years before. As more companies are raising now, the amount of down rounds is declining because we are more to a more basic and normal market correction now. So these valuations we had in the past were simply too high. They were too good to be true, sometimes. And now we are coming and reaching a normal level, and this is the consequence, and I don't think this is a major problem here. This is just a normal correction. Now, this one we really put a lot of effort in. We pulled for you the last data from last week, and we wanted to see where are we with these pre-money valuations for our rounds. And we made some quite interesting observations. So what we could see that the late series C and D, those valuations, especially D, are declining. And the earlier A and B are actually increasing. So how can this be, you know? So there is a value inversion, which means if you are in Series A and B, you have a relatively higher valuation than you get to the later rounds. So there's a risk of correction when you reach the higher series. If you approach from B to C, from C to D, you may have your down round later. And I think, it is speculation, there's no proof, it's probably because the VCs are forced these days to make more companies, to fund the companies for much longer, with more generously, and in larger rounds. And so these larger syndicates enable them to reach solid value inflection points. So they give more money to the companies to really get an endpoint which is really valued by the customer, which is pharma or biotech, you know. So this way they basically protect themselves from having a down round to the market, because it's going from one VC to the next VC, and they are in a club situation. That's what I think is happening. And I think it's fair, because those valuations are not too high when you look at where they are right now. So now this is an interesting one. This is the difference, the delta between pre-money and post-money, and you see it by series. And this, I've never seen this before, so we did this. And what you can see here, first observation, in 2015 we needed 56 money on the bottom on the left, $56 million on average for all series to bring a company from series C, from the seed series to the D series. Now in the 2020s, we're talking about $200 million. So it's about a four-fold increase of money, which you need today than about 9 years ago, to get the same companies, to get the companies through the same series, okay? But is it comparable? So I think through these larger rounds which we are raising now, in 2015 we probably had smaller rounds more often, and in 2020 onwards we have larger rounds less often. I think that a company in Series D or C is not comparable to in 2024 to a company of 2015. The company in 2024 will be much more advanced. So they had much more money, they had much more to show. And so this is a little bit of a theory here, but the message to be taken away, and that's for us, how much money do you need to come to your exit? All right, please think about this when you start, not when you're in the middle of the way, you know. And this is the message we have to have here. What you can see as well is, let's say we are Series D here. I flip back, look at the blue curve, 80 million pre-money in Series D. You raise $95 million. You see the red dot on the right, so you have a 60%, almost 60% dilution in your last round. So the bill is at the end. You know, the last round is making your return, no matter how well you negotiated the rounds before. So come to your exit, plan it well. If you need a Series D, make sure you're getting there and plan for this. Now, what are the conclusions for us? Before I go into details, I think they are pretty bright, but let's go through them. So big biotech and big pharma want clear evidence of clinical differentiation. And they focus on assets which fill their pipelines in the next 3 to 5 years, which are their erosion problems, you know. M&A deals are targeted on products on the market or in late-stage clinical trials. So that means for us, VCs have to invest more in clinical versus preclinical platforms, and it's the reverse, which was 5 years ago. 5 years ago, more money went into early. And the number of early-stage rounds is falling. On the other hand, those which get financed probably get more money. This focus or forces the VCs to fund companies for longer, more generously, resulting in a growing VC fund sizes and bigger rounds. So managing dozens of smaller deals is too resource intensive, so they will focus on less deals, and those which they do early, they will put more money in. That's my prediction. Companies need to find a marketable exit endpoint, a clinical commercial value, and that's what I can't repeat often enough. The short-term financing to the next round thinking, you know, may end up in Death Valley with money spent, but no sufficient evidence created for an up round, the exit, or the next round. So now the absolute final conclusions. Good news, projected revenue erosions from pharma means there is a need, there will be much money coming to us to be bought. M&A will remain solid and very active, and there will be huge amounts of money will be spent, but selective. Biobuck deals are tough, they have to improve. The upfront is only 6 to 7%, there's no real exit, cap value, total deal value really rarely reached, you know, so you made a $2 billion, $4 billion deal, but effectively you will only realize $700 million maybe. Still good, but US government discounts, they punish this industry, but this industry is doing well. Nevertheless, with rising development costs, the drug NPVs and biotech exits may be in a sandwich situation, you know, so on the top we get NPV reduction, on the bottom we get increasing costs to come to the exit. But, oh, I see this went further. So I think this can be managed. So as long as the IPO exits are closed, it's cyclic, they will come back. We have to be smart and effective and efficient in development paths. So we can't do the same stuff as we did 20 years the same way. We need to find better, more efficient and resourceful management of the financings we get in this current situation, which is manageable. So please plan the total capital needs from start to finish, not just for your next lab bench or, you know, so from start to finish, and the time required. And realistically, careful planning. You know, we need to balance in this market then the valuations and terms expectations from the companies with the financing reality, and it's required to, which is required to reach the inflection points. We have to come together. So past high valuations have been and will be corrected, which is normal. But we are simply back to normal levels. So we are on very good levels. We are higher than we have used to be 10 years ago in all the money we are getting in the industry, in the venture rounds. And we will have a bright future in our longevity biotech industry. And again, we are on the right side of evolution at the right time. And management and VC need to team up for the entire way, and it will be all of success, I think. Thank you very much. Wow, in time.
Thank you. Thank you. Thank you so much, George. It was a really great talk. I think we unfortunately have to move on because we are late.
Yes, just was on time.
But please speak to George.
Yes, come. I will be out.
This is an extremely important topic for driving the field forward. So sincerely appreciate it and appreciate the support from LongeVC. But thank you so much.
Thank you as well.
Give him a round of applause. Thank you so much.